Hello, very good morning to all. I hope that you guys all have a great weekend and a restful weekend. Welcome to today's daily dose of market insights and welcome to a brand new week ahead. I'm Kelvin Wong here again. Today will be Monday, the 6th of May 2024. So before we start our daily dose of market insights, pardon me, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into today's short-term technical outlook on the various broad-based cross-asset classes, let's have a recap what has taken shape on last Friday, over the weekend, and as well as today's early Asia session before the start of our daily dose in terms of news flow, economic events, and their impact on their key respective price action on the various asset classes. So let us start on last Friday first. So as we know, last Friday, the all important data, there's actually two data, but market chose to focus mainly on the US non-farm payroll data, but pay lesser attention to the ISM Services PMI data. Later I'll explain to you all what's this ISM Services PMI data about. So I believe that you guys know the all-important non-farm payroll data, which telling us the state of the US job market. Why is it important? Because it's one of the economic metrics or data set that the US Federal Reserve will actually use to gauge the monetary policy direction. That means, i.e., whether to hold rates, hike rates, or cut rates. Eventually, it will actually impact the US Treasury yield, both on the short end and the two end, which eventually will actually create a feedback loop into the key cross asset classes, the major stock indices, the FX market, the bond market, and as well as the gold market, which is the i.e. the commodity market, because gold and dollar do tend to have an indirect correlationship from the conduit of that US 10-year treasury yield. Okay, so now let us look at the price performance of the US stock market. So the US stock market on Friday continued to rally on the backdrop of a very weak, lackluster non-farm payroll data. Because with a weak non-farm payroll data, that means, i.e., we're telling us the job market seems to be getting softer, that increase the odds of the US Federal Reserve of cutting interest rates rather than hiking interest rates, given the fact that if we know that in the last 1.5 weeks, there's this fear about stagflation coming back into the market. Why? Because oil prices continue to remain firm, and as well as what we see over here is that various economic data like last month CPI data and as well as PPI data, and that famous Fed tends to actually monitor in terms of inflationary trend in US will be the PCE data, indicating to us that the US inflationary trend still remains elevated and sticky, especially from the services side of the story. So with a slowdown in that job market, but not that bad, I mean, it's not like a recession scenario, so markets view it as a Goldilocks scenarios, so that actually pushes the US stock indices. So before we jump into the performance of the US stock indices, let me share with you all that trend of the non-farm payroll data that was out on last Friday. Okay, so you guys have a better picture. So yes, this is the non-farm payroll. So markets, okay, where is it? Yeah, good. Yeah, so market is actually expecting 243k jobs added, but it came in way below 243k and way below 315k that was printed last month. So 175k that was below expectation, but so it indicates to us that the job market is not as hot as initially expected, lower the odds of an interest rate hike. But if you look at the trend of the non-farm payroll data, rather than taking the absolute number of 175k, we may think that it dropped down by from 315k to 175k. That seems to be a fair bit of a lot. So if you look at the 5-year trend over here, okay, it's rather flattish. So it's still rather flattish in a one and about close to about 1 year plus, it's been in a kind of a flattish range like scenario. So that actually indicate to us that over here is that the US job market is softening, but it's not in a state of a recessionary like scenario yet. So that actually pushes the US stock market. So last Friday, the US stock market is being led by number one, the very strong performance in the mega cap 7 stocks. All right, the stocks that have very high weightage in the S&P 500 as well as the Nasdaq 100, which is the all famous big technology company. Microsoft added 2%, Apple whopping 6% due to its record breaking share buyback program of 110 billion that was announced a day before. And Nvidia AI optimism continue to be inflow 3.5%, right, together with Meta 2.3%. That was on last Friday. But if you look at from a weekly perspective, so if you put it on a 5-day performance, if you look at the 1 week performance, the market performance is actually not that great within the mega caps stocks. All right, why? Because you see a bit of mixed picture. Microsoft almost unchanged. The one that is leading the fort is in fact Apple, which is supported by that 110 billion share buyback program, which is up by 8% for the entire week, and followed by Amazon up by close to 4%, and Meta, which is up by 2%. The rest of it is pretty mixed. Google is down negative 2.7%, almost unchanged for Microsoft. Nvidia, yes, positive 1.2%, but the entire chip sector doesn't look quite good on a weekly perspective. So if you stretch it from a weekly picture over here, what we could see over here is that the markets doesn't seems to be quite optimistic for the entire week. So what we could see over here is that the market only push up very lately on Thursday and Friday, okay, right after the Apple share buyback, then followed by the US non-farm payroll data, which came in slightly weaker than expected. But market chose to ignore the uh, stagflation risk scenario that's being painted out on the ISM Services PMI data. Okay, so this ISM CPI data is pretty much important. Why? Because ISM data tends to be much more leading in nature rather than the non-farm payroll data, because ISM data is based on survey base. All right, it's a survey based data. So if you look at the ISM service number PMI data, it actually deep down to a contractionary mode, 49.4, below 51.4 in March, and also below 52 that was actually penciled in as the consensus expectation. And what's interesting, within the sub component of the PMI data, we do have ISM services prices. So these prices are actually prices paid by the services industry, considered as the services industry cost of doing business. That's the easiest way I could explain. So for services prices, it actually went up as well by a fair note, 55 expecting, but market expectation, pardon me, it came in at 59.2 and way above last month of 53.4. So if you plot it like a trend on trading view over here, this is the ISM services PMI. It dipped down to 49.4. So we could see that the pace of expansion has decelerated, and now it went into a pace of risk of contraction as well. And what we could see is that services prices seems to be on the path of rebounding, higher low. All right. So would it be potentially what we see in late October 2020 that give rise to the start of that interest rate hike cycle conducted by the Fed? If this services prices going to rise in the next few months, the possibility of an interest rate cut will get reduced. But that is not being priced into the market on last Friday, because last Friday market chose to be more jubilant on the Apple share buyback program, and as well as the weaker than expected non-farm payroll data, and market chose to ignoring this price action, which means that, i.e., there could be a risk of a downside surprise for the US stock indices. If next month the services PMI prices going to inch up much higher, and what you see over here is that the manufacturing prices has started to rise much more steeply as well versus the services. Yeah, because manufacturing, we may tend not to ignore it. Why? Because the manufacturing industry is much more lower in significant in terms of economic contribution in the US economy versus the services sector, which contribute to two-thirds. But don't forget, everything is interlinked. Whatever prices that the cost of business in the services industry get were more or less related to the cost of business that the manufacturing sector incurred. There's this particular chain impact. All right, and for sure, the manufacturing PMI also continues to be in a contractionary mode. All right, since October, yeah, it was since give me a minute, November 2022. Okay, so all in all, right, this latest showing of ISM Services PMI and ISM Services prices paid on last Friday, indicating to us that stagflation risk narrative is still pretty much alive in the US economy. And the crux of it is that risk asset, the stock market, hasn't priced in fully this scenario yet, which could, down the weeks ahead, trigger another leg of negative feedback loop potentially. All right, so that's the story on the highlight on last Friday. And because the market chose to ignore this scenario, the dollar actually weakened significantly on the intraday basis on last Friday. But what interesting over here is that the dollar index, yes, even though it's so off, but it managed to stage a bounce during the later part of the US session, right at the upward sloping 50-day moving average. Okay, so later I'll touch on the technicals, more details on the technicals when we cover the short-term technical outlook. And one thing I want to highlight on the weekend over here is also related to Apple, is Warren Buffett conglomerate with Berkshire. Berkshire Holding makes its earnings announcement and on the weekend, which is on Saturday. So market will be paying very close attention to his holdings because he do hold a couple of key component stock on the S&P 500. And what's interesting over here is that Berkshire conglomerate, which is Warren Buffett holding company, actually reduce the Apple stake, the stake in Apple. All right, so he reduced. Okay, where is it? Was over here. Yeah, Apple. Okay, so the company actually sold some of its Apple stake in the first quarter. All right, reporting at 134 billion stake at the end of March, down from 174 billion at the end of last year. And what's interesting over here is that after he reduced his Apple stake, he did not use this cash proceed to purchase much more investment, but instead he chose to increase his cash holding. So his cash pile actually rose to 189 billion. So during the press conference, Warren Buffett stated that there's lack of opportunity for investment due to macroeconomic risks that he stressed. So given the situation over here is that if you guys believe in value investing over here, that means given the current valuation of the US stock market in the medium term perspective, it doesn't seem to be pretty attractive from Warren Buffett perspective. Okay, something mindful to look out for if you have a longer term perspective. That means, i.e., what Warren Buffett implied over here is that he do believe that the S&P 500 could shape another downside risk from a medium term perspective. All right, that's why he chose to actually hold his cash pile at a record high level of 189 billion to store dry powder for the next opportunity. That's one way you look at it based on the implied weight or from a valuation perspective. And on the hand over here is that we know that at the start of this entire week, there is actually a talk about ceasefire in that Israel-Hamas war that also caused a sell-off in oil prices. Why? Because oil prices is now part of this weapon of choice, unfortunately, for diplomacy, because Iran is involved as well, and the Middle East is in the Middle East region, all right, due to potential disruption. Oil price for this entire week is down by -7%. So that is so far the worst weekly record since at the start of this year, down -7%. But what's interesting over here is that yes, even though it's down -7%, it managed down -7%, not 17%, 7%, but it managed to help at the key pivotal medium-term support level that I highlighted on West Texas crude oil, $78.40 per barrel, and that actually managed to hold on last Friday. It test and it did a bit of bounce on last Friday before the close of the US session. But what's interesting over here is that over the weekend, there's actually this news flow that came out saying that there's actually unfortunate event where Hamas actually hit the Israel border crossing. So this Israel border crossing is very important. Why? Because it's a crossing for humanitarian purposes. That means it's for people to actually go to a places where there is less risk of a we call that a crossfire, and as well as for humanitarian purposes like aid and food to pass through. But there is on Friday, Hamas actually hit this Israel border crossing, and right now there is actually this potential talks between that ceasefire talks where this exchange of hostile between Hamas would actually give exchange hostile to Israel to prevent Israel from attacking Palestinian. This ceasefire talk right now is in jeopardy due to this weekend unfortunate bombing on the Israel border crossing by Hamas. So what transpired over here is that oil prices managed to tick up slightly higher during the Asia session, and gold prices continue to remain firm as well, holding above that 2003 psychological level. So later I'll touch more about that. All right. Then before we jump into the short-term technical outlook, one more key news flow I want to highlight over here is related to China. So China this morning, before the start of our daily dose Asia daily dose session, ISM Services PMI, which is compiled by the private sector rather than the government MBS statistics board. So this ISM compiled PMI consists of more uh, SME companies operating in China. So the services side of the story, nothing big surprise. It came in at 52.5 within expectation of 52.5, pretty much flattish in terms of pace of growth because it's almost unchanged from the month of March. So if you look at the trend of the ISM Services PMI data over here, okay, so it's pretty much flattish since December last year. All right, holding at around 52 level. Okay, so that's indicating to us that yes, it's still expanding, but it's neither the pace of expansion is neither increasing nor declining. So it's rather flattish at this point in time. Okay, so also indicating to us that yes, the Chinese authorities may not be so ambitious or so impactful for the need of injecting massive stimulus policy going forward potentially. All right, so with that sum up the key data highlights and as well as the intermarket relation that I'll share with you all for today. So now let us jump straight to the short-term technical outlook. All right, so now let us start with the US 10-year Treasury yield first, and how does it impact that US dollar index, which eventually also impact that stock market as well, right? Given that the US 10-year Treasury yield is being used as a benchmark for long-term cost of funding. Okay, so this is the US 10-year Treasury yield. So in terms of trend, right, the prices came down and right now is hovering around that 4 point, okay, this level here. Okay, it retested that 4.5% level, okay, and but it's still holding above that 4.3% key medium-term pivotal support level, which is the 50-day and the 200-day moving average. So indicating to us that yes, even though we see this dip that take shape 1.5 weeks ago, and it was amplified on last Friday, weaker than expected non-farm payroll data, where market chose to ignore that stagflation risk scenario that's being implied from the ISM Services PMI and the ISM Services prices paid. But overall, from a technical perspective, we can't say that this move up here on the US 10-year Treasury yield from the low of December last year is game over, and we may now start to see the start of a multi-month push down in the US 10-year Treasury yield. So as long as this 4.3% medium-term pivotal support holds, this US 10-year Treasury yield still is in a midst of a medium-term uptrend phase, which implies that going forward, the 10-year Treasury yield could actually increase upwards. Okay, that actually lead to what I call the medium-term US dollar index uptrend. It's still intact. Okay, look at the dollar index over here. Okay, the dollar index. Okay, so what we could see over here is that on last Friday, it came down and it tested the 50-day moving average right exactly above the key medium-term pivotal support that I highlighted earlier at this, okay, let me see, what's this level? Yeah, this 104.20 level, 104.20 level, which confluence with the 200-day moving average at the lower boundary of this medium-term ascending channel that is in place since late December last year. So what it means that it could be the start of a potential bullish reversal point right exactly at the key medium-term pivotal resistance. Why? Because of that bullish daily hammer candlestick that was formed on last Friday after that initial sell-off that is being triggered by the weaker than expected non-farm payroll data. But market actually rebounded towards the end of the US session, supporting at the 104.20 level and lead to the formation of a daily bullish hammer. So this could be a potential inflection point or a bullish reversal point, indicating to us there could be a fresh up leg of impulsive up move that could unfold in a couple of days for the US dollar index. That means we're talking about dollar strength that is still intact, coming back into the picture based on the technical trajectory of the dollar index with inter-market analysis taking into account of that 10-year US Treasury yield. So if the dollar starts to actually strengthen from here at this point in time, it also does not bode well for stock indices as well from a medium-term perspective. Yes, on the shorter-term perspective, we may see about a bit of whipsaw here and there for various stock indices. Why? Because short-term perspective on the intraday basis, the respective shorter-term technical condition plays a much more impactful, we call it impact, rather than the medium-term intermarket correlation or analysis that I shared with you earlier, taking into account the 10-year, how does the 10-year US Treasury impact the dollar, and how the dollar impact the broad-based stock indices, all right, from a risk-on, risk-off perspective. So dollar strength comeback tends to be risk-off from a medium-term basis, all right, and we cannot say that the dollar strength is game over from what I explained earlier on the positive technical element on the dollar index that is being playing out right now. Okay, so with that, now let us jump straight into the FX market. All right, so on the FX market, let us interestingly look at the Asia one first before jumping into the US market, starting into account of the dollar yen. All right, okay, now let me expand my screen so that you guys could see. Okay, good. So this is the dollar yen over here. So the dollar yen actually continued to bounce over here pretty much strongly here. So previously on last Friday, we do have a bearish bias looking for it to kind of retest the 50-day moving average over here at this point in time. Okay, I hope that my voice, give me a minute now. My audio is fine. Okay, okay, so I think the audio is good. Okay, good. All right, so where we are. Okay, so the prices of, okay, give me a minute just to make sure everything is okay. Yeah, so that you guys could, the screen is showing. Okay, so on last Friday, right, we do have a bearish bias over here is for the dollar yen to actually kind of see a retest on the 50-day moving average at 15160. We came very close and bounced off it. So what we could see over here is that this bounce itself has been accompanied by another higher low on the RSI, which indicate to us this bullish divergence slow down in the short-term downside momentum. So with that, we will actually be flipping to a bullish bias for today, using for sure 15160 as my short-term pivotal support level. Okay, I do not want to put it so tight. Okay, so this will be my first support level for today. Okay, so this first support level is very close to today's Asia session low at 152.90, pardon me, 152.90. I don't put it so tight at 152.90 in case of any whipsaw, because there's this ongoing, what you call it, rumored of Japanese authorities watching the yen market, right? Watching the yen, preventing it from getting stronger. So in between, there could be a bit of much more volatile whipsaw. So I rather put it at 15160 as my short-term pivotal support. Any potential pullback that didn't break below 15160, we could start to see this kind of potential short-term recovery on the dollar yen. First resistance to watch will be at 154.25, which is close to the 220-day moving average, acting as a resistance as well. Above it exposes 1560 figure level, confluencing with the minor descending channel resistance that I drew from the high of 29th of April, and as well as the minor swing high of 2nd of May. Only an hourly close below 15160 will invalidate this potential short-term recovery bias on the dollar yen to see another potential weakness to expose the next support level at 150.80, 149.80 next over here, which is this graphical congestion zone. Okay, that's for the dollar yen. Aussie dollar. So Aussie dollar, last Friday we will have that short-term bullish bias. It actually hit that resistance level at 66.45. Okay, 66.40. Why is it? The upper limit of this minor ascending channel that I drew from the low of 19th of April, and as well as the former minor swing low, the swing low area of 8th of March and 10th of April, that has been preventing the bulls from breaking out since 8th of March this year. So with that, the RSI also has just exited from a overbought level, indicating to us there's some form of weakness in terms of upside momentum, at least in the short-term intraday basis. So with that, I'll be using 66.45 for today as my short-term pivotal resistance to potentially seize a dip on the Aussie dollar. First support level to watch out for in this potential intraday weakness on the Aussie dollar will be 65.75. A break below 65.75 exposes 65.20, which confluence with the lower limit of this minor ascending channel support from the low of 19 April, and as well as close to the 200-day moving average and the 20-day moving average, also acting as a support around the 65.20 level as well. An hourly close above 66.45 will invalidate the short-term pullback bearish bias scenario to see the continuation of that potential push-up in the Aussie dollar. Next resistance to watch out for will be 66.80, followed by 67.30, and 67.30 is pretty key. Why? If you look at the daily chart on the Aussie dollar, okay, 67.30 is in fact the upper limit of this complex symmetric triangle range configuration that is in place since 13th of October last year. Okay, so it's been trapped in this symmetrical triangle range configuration since 13th of October last year, and the upper limit of this symmetrical triangle range configuration is now acting as a resistance at 67.30. So that's the daily chart of the Aussie dollar. Okay, now the European currency, looking at the sterling dollar. So the sterling dollar, very interesting, did a intraday push up and now went back down below that 125.70 short-term pivotal resistance that we highlighted on last Friday. So given the fact that it's more like a whipsaw, okay, where is it? Let me put it down here. Okay, so given the fact that it's more like a whipsaw instead of a clear breakout of 125.70 level, and also the price action so reintegrate back below the descending trend line, the minor descending trend line resistance that I drew from the high of 8th of March, okay, indicating that there is no kind of very clear bullish momentum breakout. So I view this as something like a failure break instead, and the price also got rejected at the 50-day moving average. So with that, right, I'll be using 120, slightly above tolerate a bit of excess above 25.70, so I'll be using 26.40 today as my short-term pivotal resistance level. Still maintain that short-term bearish bias on the sterling dollar. For the first support level to watch will be at 124.60. This will be the first support level to watch for today on the sterling dollar. However, a breakout above an hourly close, a breakout above 126.40 will invalidate this short-term bearish bias to see the potential continuation of this corrective counter trend rebound scenario to continue to play out. It's a kind of very complex sideways range. 126.10, the next resistance to watch, followed by 128 figure level on the sterling dollar. As for the euro dollar, so euro dollar last Friday also squeezed up, but the squeeze up managed to actually get rejected right at the 200-day and 50-day moving average, acting as a resistance at the 1.08 level. So I will actually kind of be more mixed for today. So neutral between 1.08 on the euro dollar and 1.0730 on the euro dollar. Okay, so net, right, overall, we do see some form of dollar strength, potential revival from a intraday short-term basis. Major stock indices, all right, let us start with the Hong Kong 33. So Hong Kong 33 on last Friday, we flipped to a bearish bias. Why? Because it hit the resistance level, which is the top of this minor ascending channel from the low of 19th of April. And at that point in time, the RSI also hit the overbought level. So what we could see over here is that the RSI now indeed shaped a bearish divergence on last Friday, and it starts to exit from the overbought level, indicating to us that this momentum here, the momentum that was pushed up on last Thursday, is losing strength, and there is a risk of an increased risk of this minor pullback scenario that is playing out within this short-term uptrend phase that has been evolving since the breakout of the 200-day moving average on 26th of April. So with that, right, we will still maintain that short-term bearish bias for that pullback scenario to play out, minor pullback scenario to play out. 18,800 short-term pivotal resistance for today, no change. Support level to watch for that minor pullback scenario to play out, potentially play out, will be at 18,000/17,900, conferencing with the lower limit of this minor ascending channel and the former minor swing high of 29th of April and 30th of April. Only an hourly close above 18,800 will invalidate this minor pullback scenario to see the continuation of this rebound, short-term recovery phase. Next resistance to watch out for 19,390, followed by 19,980, which is the graphical resistance over here. Okay, the projection of this graphical resistance. That's for the Hong Kong 33/Hang Seng Index. Now, what's next for the Japan? So Japan 225. Japan today is actually, stock market is closed today for a public holiday, but the futures is still open. That's where our CFD index is tracking the futures prices right now. So for the Japan 225, yes, prices squeeze up like the major US stock indices, but it's still below that 38,800 short-term pivotal resistance level. So with that, it's now at the extreme overbought. So there could be a chance of a potential minor pullback scenario unfolding. So we will still maintain that short-term bearish bias within this sideways range configuration as prices still remains below the minor descending trend line that I drew from the high of 22nd of March. So first support level to watch out for will be at 38,320. A break below 38,320 may expose the next support level over here at 38,000 figure level. All right, so still maintaining that bearish bias for that minor pullback scenario to play out within this complex sideways range configuration on the Japan 225 that is in place since the low of 19th of April. However, an hourly close above 38,800 may potentially see a bullish breakout scenario unfolding. That means we may start to kickstart a new impulsive upmove sequence. Next resistance to watch in the first step will be at 39,130, followed by 39,480 next on the Japan 225. Now, German 30. So German 30 last Friday continued to be in a sideways range. So last Friday we do have a bearish bias below 18,150. Looking forward for it to actually come down to retest 17,900, 17,840, but prices going to be pretty much resilient, holding above the 20-day and the 50-day moving average. And the RSI is also slowly ticking much higher, forming a higher low above the 50 level. So there's some form of bullish momentum creeping back into the market based on the hourly RSI current, the observation. And what we could see over here is that since 24th of April, that means potentially the German 30 index could be trading in a ascending triangle range configuration. Why? Because it starts to form higher low and similar high. So that is a potential consolidation configuration. So with that, right, I will be flipping to a short-term bullish bias within this range configuration because of that positive current hourly RSI element that is playing out. So bullish bias above 17,970, which is close to the 50-day moving average and last Friday low. As long as this level is not broken down on the downside, potentially it could actually float it up to the top of the range, of the symmetrical range. A breakout above 18,150 will increase these odds for the next resistance to come in at 18,310 on the German 30 index. Only an hourly close below 17,970. That means, i.e., this symmetrical triangle range configuration will be invalidated to see another round of choppy move to retest the swing low area of 25th of April at 17,900/17,840. A breakdown below it, much more drastic, exposing the 19th of April swing low at 17,550. So for now, the current technical configuration is kind of supporting this kind of a price action evolving within this within this short-term minor ascending triangle range configuration that is unfolding since 24th of April. Okay. Now, the US stock indices. So US stock indices, given a rather mixed element on last Friday. So last Friday price action on the Dow Jones Industrial Average managed to squeeze up above the 38,590 short-term pivotal resistance level, but where it stopped towards the end of the US session is right exactly at the 50-day moving average, and the RSI also managed to exit from the overbought level. So given this rather mixed element, at this juncture, I would rather turn neutral for the US Wall Street 30 for today. So neutral between 39,050, slightly above the last Friday's swing high at 38,810. So I use 39,050 level, which is also close to the golden ratio of the Fibo retracement of the previous down move from 1st of April all the way down to 19th of April. All right, over here. So neutral between 39,050 and 38,415. Similar for the Nasdaq 100 as well. Managed to squeeze up above our short-term pivotal resistance that we highlighted on last Friday, 17,720 level. And what it did over here, it actually stopped at 17,965, which is right exactly at the 50-day moving average as well. Okay. So with that, element is kind of mixed on the Nasdaq 100. The RSI now is trying to exit from its overbought level. So neutral between 17,965 for today on the Nasdaq 100 and 17,640. All right, which is also close to the 20-day moving average that was taken out on last Friday. Okay. Now, spot gold XAU/USD. So for spot gold, what we could see over here is on the daily time frame. Okay, price action seems to be rebounding off the 50-day moving average, and the RSI now is turning above the 50 level mark, and as well as turning up above the 50 level mark, and right exactly at the key parallel ascending trend line support that I drew from the low of 5th of October last year. Okay. Now, so from on a daily basis for spot gold, no change, right? It seems to be evolving within this potential minor bullish descending wedge configuration with the bottom of the wedge at 2,265. So I don't put it so tight at 2,075, which was last Thursday last Friday's swing low. So 2,265 still remains as my short-term pivotal support level. Potential short-term recovery scenario to play out. First resistance to watch out for, okay, will be this swing high here. Okay, so it's like a zone. Okay, let me put it in red. Oops. Okay, 2,350, 2,365. All right, this area here, which is the upper limit of the minor descending wedge configuration, as well as this congestion area here previously as well. So it's a zone between 2,350 and 2,365. Only an hourly close below 2,265 invalidate this short-term recovery bias scenario to see the continuation of this corrective decline scenario to unfold, to kind of expose the medium-term pivotal support at 2,235/2,210 level, which is so confluence with the upward sloping 50-day moving average. Okay, so that's for spot gold. Then for West Texas Oil, so West Texas Oil the sell-off managed to stall at the 78.40 medium-term pivotal support level, which is also the lower limit of this medium-term ascending channel that I drew from the low of 13th of December last year. Okay, so with that, still no change, still using that 78.40 level as my short-term pivotal support level, looking for at least a potential recovery to unfold on West Texas Oil. First resistance level to watch, no change, will be at 80.80/81.50 level. Okay, only an hourly close below 78.40 will invalidate this short-term recovery bias scenario to expose the next support level at 76.90, 75.50 level over here, the next graphical short-term support level. Okay, so with that, that sum up the short-term technical outlook on the broad-based cross asset classes. So now let us take a look at the economic calendar before we go. So today economic calendar will be rather quiet even during the European session, nothing key to look out for. All right, and even during the US session as well. Only in the later part of early morning Singapore time at 12:50 a.m. and 1 a.m. we have two federal officials speaking, which is Fed Barkin and Fed Williams. Okay, so that's all in terms of the economic calendar. And with that, I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.